Hi, everyone. Good afternoon to most of you, and greetings also to all of those who will watch us later in the recordings. My name is Leoncio Montemayor. I'm a project manager at Solarplaza, and it is my pleasure to be the host for today. So welcome to today's webinar, Thriving Within Spain's Solar Bubble 2020 and Beyond. We have two great experts, to Manuel Cabrerizo, partner at Voltiq, and Keats, director at Ekon, who will be telling us more about their vision on Spain's solar bubble. And actually, this idea came around, I think, end of last year when we were doing some survey with our database. We sent out a survey to 50 professionals, which answered back, and the question was basically, okay, is the Spanish industry living in a bubble? So out of the 50 respondents, actually, it was almost half-half, right? So this posed a very interesting question because it's a very divisive question. So we're going to explore that question today, and let's see if those numbers change by the end of the webinar. So just a little bit on the agenda. I'll start with a brief introduction. And then we'll go to two 20-minute presentations, one by Keats, first by Keats, and then by Manuel, and then we'll finish with the Q&A. So for all of you who don't know us, Solarplaza, our mission is to positively impact the world by accelerating the sustainable energy transition. We basically have organized more than 100 events. We work all around the world, and our network consists of 60,000 PV professionals and counting. So this is a little bit how, well, we're doing this webinar in the run-up to our event, Solar Market to Parity Spain, in the 19th of March 2020. These are some of the companies that have joined us. So if you want to partner for this event, feel free to contact Eduardo. This is the program. We're actually, the 18th of March, we're going to have a pre-conference networking dinner at a beautiful terrace in Gran Via. So let me just show you a little bit how it looks like. Oh, beautiful. And we're also gonna, the day of the conference, we're gonna cover a lot of topics such as the ones you see on the screen: unsubsidized assets, grid access and connection, a very important topic with Red Eléctrica and CNMC, financing the next decade of projects. We're gonna talk about the electricity markets and many other interesting topics. So I invite you all to join us the 19th of March in Madrid. And just as an announcement, we have the early bird expiring tomorrow. So make sure to get your tickets and register today or tomorrow to enjoy these discounts. And finally, please visit our website, spain.solarmarketparity.com, for additional content. We have the Spain 2020, the Road Ahead report. So you can download that actually right now from the handout section in the control panel of the webinar. And we also have like a mappa with all the announced PPAs in Spain. So some practical information before starting the webinar. So if you have any questions or technical issues, you can directly use the question box in your control panel. Please make sure to send in some questions during Kim's and Manuel's presentation, and we will be able to look at them at the end of the presentation. And as I said, the Q&A session is at the end. Slides are also already available in the handout section, and the recordings will be available tomorrow at 1 p.m. when we'll send you an email with the link. So without further ado, let's get started because this is going to be a good webinar. I'd like, with the honor, to introduce Keats, director at Ekon Strategy Consulting. He has a lot of experience working not only in the solar energy sector, but in the broader energy sector, and he has supported more than 47 gigawatts of transactions and projects in his career of more than 17 years. So, Kim, I leave you to your presentation, and the floor is yours.
Hi, everyone. Gracias, Leoncio. Thanks for joining us for a second year, I should say. In case you missed last year's event, I'm actually going to be using at least one slide from there and refer you back to that. Those who know me know that I have a tendency to speak very quickly, and that can be, it's easy to leave people behind. This subject is a little bit it's also technical, which is why I'm speaking first. Manuel will have some very interesting things to point out with the view of to how it is that we think about whether there is a bubble or not. I will get to the point of defining it at some point. The things I want to cover today are, well, here's a little bit of information on Ekon. It's basically repeating a little bit of the information that Leoncio just referred to. I'm not going to go into that. These are the four things I want to raise. The first one is to put the context of where we are today with respect to the big additions in the year 2019 into context. You know, have we seen somewhere else? Have there been other bubbles in Spain? We may talk about bubbles in other countries, but we're going to try and focus, and the answer is yes. And my opinion is they can be led by regulatory errors, I suppose you could argue it that way, or they can be led by simple misinterpretation of the market signals. So funny enough, we actually have examples of both of them in Spain in the last 20 years. Then I just want to raise the issue on the key concept again about the issue of, look, how close are we to the cliff edge? In essence, we could be on top of the table, you know, enjoying ourselves from our perspective, and finding ourselves much closer to the edge. The edge being wherever it is that we have too much capacity coming online, and prices begin to drop off for the assets, and also because we're in a position not to be able to recover our investment returns. To put that into context, I have a few quick results from some modeling we did Q4 of last year, that's 2019. And just to bring it into context, comparing it to the PNIEC, which is the National Energy and Climate Change Plan for Spain, right, which has targets for 2030, decarbonization being the main theme of that. If we move to the next slide, I've got on the left-hand side the existing capacity mix as of the end of 2019. So these are Red Eléctrica figures which were published within the last week or so. What's interesting, if you look to the right-hand side, you actually see the evolution of capacity over time. One of the things to point out is we've got a particular situation from last year where we have an increase in capacity, which is quite unique. If you look at what's been going on previously, we've got a very quiet situation. But if you look at this red line, here what I'm trying to define is the actual movement of demand, or the expectations of demand if you're doing an assessment of building. In this case, I'm going to try and talk about two types of bubbles. The first one was driven by combined cycle development in the 2000s, and then the PV around 2007, 2008. Notice that if you draw a straight line on where demand was expected to go, it seemed to be a pretty good idea that you'd build a bit more combined cycle power stations. As a matter of fact, what happened was that a lot of that got left behind. And as we do know, there's a lot of CCGT on the Spanish system that doesn't run very much. Nice example of a bubble. The other example of the bubble is the one I mentioned about PV. And then obviously, if we're looking and making a comparison to the figures that have been added last year, 4,000 megawatts of photovoltaic capacity, net additions, I should say, because I'm not sure exactly whether anything closed down, doubt it. So I think those are basically a clean 4 gig additions. And let's not forget, we also have 2.2 gig of wind capacity that got added to the system as well. So let's look a little bit in a bit more detail at that. On the left hand here, we've got the evolution of combined cycle capacity. We've got, you can see how there was nothing before 2000. New technology. Everyone thought it was a very good idea to build it up. So you see the blue curve is a cumulative capacity, which is sitting now around 25,000 gigawatts. That little green dotted line is the annual capacity factor, namely the sort of normalized, numbers of operation as a percentage of the total number of hours in the year. So these assets were being deployed on the idea that they'd be operating, 60 to 80% of the time. And as you can see, that never realized. Not only that, between 2010 and 2015, the more usual number was between 10 and 15%, 1-5. Okay, perfect example. Whoever invested as an independent in CCGTs was having to tighten their belt. Let's agree on that one. If you go to the photovoltaic capacity, the same similar evolution. Obviously, the axes are completely different. We're talking here about having added, we had about 4.5 gig as of the end of last year, and this year we're moving towards just over 8,000 megawatts. Okay, so in this case, you can see that even at the height of what was considered bubble, driven by the very generous feed-in tariffs, 2007-2008, there was a cutoff at that particular point in time. So everyone rushed into the market, and you got about 2,000 megawatts built in 2008, right? Well, we've actually surpassed that by quite an amount. So obviously the main question is, do we think that when we were comparing the 4,000 that was added last year to the 2.5 from what was quote unquote obviously a bubble in 2008, do we have a bubble today? Right? That's really the context that we're trying to have this conversation in. Now, if you ask me, I put a couple of definitions of what a speculative bubble is, but in essence, what we're talking about is trying to buy into an asset class and ultimately finding that it's being overvalued, or otherwise your expectation of what the future returns will be is higher than the ex ante than ex post, right? And at some point in time, there's going to be a bursting of the bubble and asset prices come crashing down. Now, I'm going to paraphrase that in the context of the electricity market. Remember, I'm an economist. Manuel is the financial guy, so he talks about these things from a slightly different angle than I do. So to paraphrase, I'd say, does Spain find itself in a situation where the economic fundamentals regarding renewable penetration, and in particular photovoltaic capacity, are they subject to miscalculations and can lead investors into a missing money trap? You've heard me mention this before, missing money, by which I mean you invest in something which eventually, ends up in you not being able to make your expected equity return. In that context, you may as well have you'd have been better off leaving the money in the bank. Okay. The simple answer to the question, are we seeing a speculative bubble? I don't think so. I don't think we're there yet. Okay. But the way I'm looking at it is on the basis of the fundamentals. All right. So the economic things. So how do we go about and have a conversation as to where it is that the market lies and what's likely to happen in the future? This slide is just giving you a bit of an insight as to where it is that the market sits at the moment. I got two very brief snapshots, 2017 and 2019. 17 at the top left-hand side, you've actually got the dispatch breakdown across the whole of the year. These are 8,760 hours, or thereabouts. I can't remember if we had a leap year or not. And then on the right-hand side, you've actually got the hourly prices. Okay. A lot of the information packed in the middle. I'm highlighting here on the left-hand side the fact that this past year, 2019, you saw a lot more dispatch from those orange guys. Those are the combined cycle power stations that I told you were having a bad time in the past. But that hasn't actually translated into more money for them. It just means they run a bit more, because as you can see from the right-hand side, prices haven't really jumped. The other thing to notice is that the dispatch of coal has slightly disappeared. That's the sort of slightly above the blue line. There's a sort of area of sort of reddish color, and you can see how the coal's basically gone away from the dispatch, which has led to a number of larger gencos closing down capacity. If you compare prices, and I'm doing a like-for-like comparison here, we don't, and in the early part of the year, we didn't see these price spikes. Later on, we did see a number of low price spikes. This is when the runoff from the rivers is coming on from the snow melt and the like. So we've got a series of that hasn't changed very much. And then the other thing to note is we haven't got a recovery in prices, as we had seen a slight recovery in prices in 2017 in the December months, last months of the year. And what you've actually got in December 2019 was actually very depressed prices, which has obviously made people aware that there's this issue around cannibalization and how low prices can go. Now, some of you have seen this slide before. I mentioned it in last year's webinar, so I'm not going to go into it a lot. But let's just say, let me just read the top line. It says the PV saturation point is reached when the realized price for photovoltaic capacity is equal to its levelized cost of electricity. Or I'm an economist, so I can say things like long-run marginal cost. And the whole intention around this chart is basically to demonstrate that as you increase the amount of capacity coming onto a system with respect to photovoltaic, you don't expect to see price increases, but at some point, when all the demand is being met by photovoltaic capacity or renewables in general, you can actually see a reduction in prices. So prices, what you tend to see, or we will expect to see more, is reductions in prices. That said, there is a balancing component. If the market self-regulates, people will be aware of this and won't keep on building additional capacity forever and ever. Obviously, we can't have zero prices across all the hours. Irrespective of the question of whether you're hedged with PPAs, I should add, because on that basis, you have a PPA with an off-taker, chances are they will be marking that to market, and if the electricity prices are very low, they're going to ask you for a discount. So just be aware of that. The thing is that under this idea that there is this quote-unquote saturation point, there is no missing money problem, okay? Therefore, if you ask me, when are we in a bubble? It is when we have a missing money problem and we've exceeded the amount of capacity that needs to be added or can be comfortably, quote unquote, absorbed into the electricity system. Can you work that out for Spain or Iberia in general? And this is where conceptually we can sort of build a long-term least cost dispatch and capacity expansion model, and we can do clever things. There's a number of issues which are more or less important as one goes through the list of assumptions. I'm highlighting the bottom 4 boxes here. You will have time to go and revisit this, and we are sharing the presentation in any case. So I'll quickly run through it. But if you notice, I'm just talking about in the first 2 lines, I'm saying annual hours for new PV and new wind. And then the last one is TIC, that's the total investment cost. So how much capacity in effect at the time of commissioning the plant, how much the thing's going to cost. Obviously, that's going to give us, if we have a number of, we have a nominator and a denominator. So obviously the total cost of building these machines is one thing, and then we have to average out that cost through the operational hours of the year, expected of whether the sun's shining or not, and that's going to change our LCOE figure. The second aspect that's very important in understanding where it is that you think or how quickly you achieve this saturation point is based on how much capacity you think you can add per year. So last year we saw 4 gig of PV, we saw 2.2 of wind, and we're basically using an assumption here, various assumptions of how much more capacity can come on above that. What we have to remember is that most of the capacity that came on last year was all around the auctions that were allocated capacity, where the winners were allocated capacity under the specific regime. In other words, they have a sort of feed-in tariff floor. The floor is not particularly realistic. The government hopes never have to pay out on the basis of it, but there is effectively a floor, which has sort of helped banks get more comfortable with sort of financing these types of projects. The question is, can you see the wave carrying on in the future? So, and obviously here in one case, in the low case, which is actually the renewable friendly case, we're saying yes, and in the other cases we're saying no. It'll be more difficult to bring people around to these ideas. So we come to this is my final slide. How do we then, what is it that's actually controlling this position of whether we're likely to see a bubble or not? And my answer to people is, you can worry about market prices, but the thing to really watch out for is actually what's going on with installed capacity. The saturation point can be defined in the terms of how many gigawatts of capacity are being added per year and how likely that is to upset the apple, to turn over the apple cart, and we'll begin to lose our shirts and things like that. So ultimately, it's capacity that you have to keep an eye on. On the right-hand side here, you have some projections to 2030 from our last quarterly report. And you got 3 cases, which is the Ekon low, central, and high. Those are the 3 on the right-hand side. Right smack in the middle, you've got the PNIEC, objetivo and tendencial. Objetivo is your target, and tendencial is your business as usual. So when you just make a comparison between the PNIEC cases and the Ekon cases, ours basically look a lot more like the business as usual case. The thing is that we're making quite different assumptions with respect to the number of operating hours that the generators are capable of achieving. So if we're jumping from, as you can see in 2015, 5 gig of photovoltaic capacity, and we will jump up to 27 gig by 2030, you're adding 22 gigawatts. With a slightly higher number of hours than what is expected under the PNIEC. The PNIEC is actually using historical numbers. There's a couple of slides at the end which highlight this interesting assumption, shall we call it that way. And ultimately, the question actually asked is, well, what's going on with respect to meeting your decarbonization target in 2030? And the answer is, we achieved the 75% or so energy production coming from renewable sources with the Ekon low case. Right, so it's an interesting assumption. But if then you come to us and say, look, I think we're going to have to target 37 gigawatts of PV instead of 27 gigawatts of PV, then my first observation is, whatever you do to push towards that target will create a bubble, right? It's very likely, if we know that it's going to be more than the market can generally absorb, and prices in general will be too low to justify the investment in this type of capacity. So there is a missing money problem. That's basically what I'm getting at. If you look at wind, I mean, we're saying about 37, so we're jumping from 23 to 37, comparing the 2015 snapshot to the low case in 2030. a lot of that will, some of that will actually begin to be repowering rather than greenfield. Obviously, the numbers are lower with respect to how much PV has to be added over this particular period of time. But if you compare that to the PNEG, we're talking about 50 gigs. So it's quite a, that's a significant difference in how much capacity. Again, the PNEG is using historical wind operational hours, and we think that new stuff will come on and be more efficient, and therefore be able to extract more hours, more operating hours from that. One of the other last things I want to say with respect to bubbles is, if the market self-regulates and we're achieving the targets, in theory, according to this Ekon low case, I think everyone should be fine, right? I don't think we're in a bubble situation. Obviously, if we have 100 gig of projects PV, which have got, which have got their permits with Electrica for connection, the reality is, I think, 1 in 4 are actually going to be ultimately connected. It's a bit harsh to say, because obviously the question is, well, why is it going to be this guy or these guys or this project and not the other one? And that's beyond my powers of intuition or understanding. But the thing is, if everyone rushes into the market, it's going to just collapse everything for everyone. A little bit like what happened with the combined cycle power stations, which have, unless they're operating in ancillary service market or have a very cheap gas price, they're not in a position to make a lot of money, let alone recover their capex investment cost. One of the other things that's coming out of left field, and I think we rarely talk about, but we should be aware of, is what's going to happen with auto consumption, auto generators. Putting your panels on top of your roofs and batteries in your homes, industrial premises and commercial premises and things like that. And I do have for now, it hasn't been given a lot of attention. The way to basically achieve these very significant targets for 2030, there's a lot of land and there's a lot of space in Spain, therefore, going for the large plants is the most obvious way to achieve those targets. However, if you did get a change in the regulation that allowed for a lot more, or at least a change in mindset, so that we begin to develop a lot more auto consumption, the final consumers here are actually looking at the electricity tariff, the final electricity tariff. So the final electricity tariff stays quite high and basically encourages people to move to the putting solar panels and batteries in their own homes and offices and premises. Then it'll make for an interesting thing, because we're going to have to be more observant of what the capacity additions are, because all of this might be slightly missed by Red Eléctrica, because a lot of this might go under embedded generation and might be missed from the sort of larger picture. Because obviously it doesn't matter where the electron comes from. If it's from a large PV project standalone or a rooftop solar, you're actually going to be undermining the overall level of demand. It's going to have the same impact of having a reduction on prices. So, bubbles can come from misreading the market, or they can they come along from misplaced regulatory interventions, which in my opinion, I'd say, watch out for the auctions. Auctions to achieve these targets in 2030 are actually potentially going to result in people having a missing money problem, especially if you believe the 37 gig of PV and the 50 gig of wind under the target case, right? And so my view is that right now we're not in a bubble, but we have to certainly observe the speed in which we're walking along the cliff edge, I suppose, how far we are from the cliff edge and how close we could be to the edge. So the last thing to say is really just keep a close eye on those fundamentals to make sure that that you have a bit of visibility as to where it is that the market is heading. That's it for me. Leoncio, back to you.
Thanks, Kim, for your presentation. I think a lot of statements that we'll definitely cover in the Q&A. Thanks for the great clear presentation. But moving on to the next presentation, we have Manuel Cabrerizo, partner at Voltiq. He has more than 20 years of experience with structured financing. He has closed more than 50 deals in his career, and he has worked all around the globe, now very active in Spain. So Manuel, the floor is yours. Thank you.
Well, good day, everyone. Let me start by thanking Solarplaza for organizing this webinar. Thank you, Leoncio, and your entire team. Also, thanks to Ekon for your massive contribution to the success of this session. Thank you, Kim. It's a highly informative speech you've just given. Leoncio, can I see I'm not sure my presentation's on screen.
Yeah.
Okay.
You can click the screen. Yeah, perfect.
It is. Thanks. Is there a PV bubble in Spain? Well, when the fellows at Solarplaza first asked me that question, my response was another question. In what market? And what do you mean in what market? Everybody knows there's a huge number of megawatts under development in Spain. True. I agree that most people, when confronted with the bubble question, tend to think about the market for projects. Still, there are at least 3 other markets that affect the eventual success of any PV project, or of any project in any technology for that matter. These are the offtake market, the debt market, and also the power market, which I'm not going to cover simply because I can't do better than Kim has done. So this presentation intends to discuss the dynamics in each of these 3 markets for PV projects in Spain. Now, we propose a layer approach to this analysis. The first layer, just the surface, are the headlines. Some people get their understanding of the world from headlines, but journalism, by its very nature, presents sudden events rather than gradual trends, and in doing so, often conceals progress. However, progress in this sector seldom happens suddenly. It consists of either business as usual, which for reporters is equivalent to nothing happening, or of things that happen gradually but compound over the years. So for those who get their understanding from numbers more than from headlines, our second layer, this one here, presents the facts. Still, drilling down, we will comment also on the reasons why the facts, this third layer, are what they are by discussing the day-to-day reality of the players active in that market, both the demand and the supply side. And finally, bottom layer is a look into the future. It includes what we think lays ahead, at least what we can see here. Also, at the end of each page, we will also show our interpretation of how supply and demand are playing out in the respective market. So the headline on the supply side in the market for projects is commonplace. There's a very large number of megawatts under development. All of us have read these headlines, but the fact is that all of us also know that there are no ready-to-build projects. The main reason for this is that developers' life is the closest it gets to a hurdle race. It's much longer than it seems. It requires huge levels of stamina and often larger working capital than many anticipate. Most developers started some 2 years ago when a market suddenly awoke. And almost overnight, hundreds of projects started applying. And when that happens, what you get is obviously bottlenecks in permitting. Clearly, the different levels of the administration have not responded by increasing their capacity anywhere near what they need to cope with the wave of files they deal with. So delays have become inevitable. Matters related to the grid have, more often than not, also contributed to longer lead times. Behind barrier grid bonds represent effectively applications that get declined and propose alternative connection points. The resulting negotiations for new land issues and the new site have been and continue to be all too common. And certainly all of them are signs of a heating market. The final result is one of significant delays in times of COD, as we've all witnessed, for example, with the auction assets. This situation tends to stabilize, however, and projects will eventually start reaching the finish line. In this sense, everybody expects, and as too, the number of quality projects available to grow significantly over the next few years. Beyond that, favorable developments on the regulatory front will also provide serious impulse in the longer run. At least 2 new decrees setting a more favorable regulation of grid access in this country are expected to come into force shortly. The immediate effect will be one of largely increasing the number of projects which can connect to any given point of the current grid without any new investments. This will be the new generation of projects that will feed the market from 2022 onwards. The demand side shows all the effects, however, of more than 10 years, or close to 10 years of QE, quantitative easing. What I mean by this is that certainly we all live in competitive environments, but the degree of hyper competition we are seeing among equity investors looks to us harder than most other markets. The fact is that the situation has driven returns down to what not long ago would have been considered too low to bother. Hit ratios are depressed too, obviously. The buy side knows that of every 10 arrows, 5 basically teach them where not to shoot, 4 are just to slow down the competitors, and then only 1 hits the target. Of course, the sell side tends not to look any further than price, so the result is a capital shootout with a significant opportunity cost for everyone involved. Of course, easy monetary policy will continue, so the rational expectation is for the situation to get worse. Obviously, one of the effects we're seeing already is that financial investors have been taking serious portions of development risk for some time in an obvious attempt to improve their IRRs by reducing their acquisition costs. So a reading of the project market is that it still shows a balanced situation. So in that sense, we do agree with Kim's conclusion. It's not a bubble yet. One would tend to believe that there is one in the making, though, when looking at the supply side, but then demand will also remain strong. So even though there have been some downward adjustment to project prices, it is not obvious to us that they will fall significantly in the foreseeable future. Now let's take a look at the offtake market. Spain's offtake market is dominated by an endemic shortage of long-term power buyers. True. The headline is that many intensive power consumers are showing interest in buying from renewable projects, and they're attracted mostly by attractive long-term prices. But also true that they're coming from far away in terms of their understanding of what a PPA really entails and of what the project actually needs. So the fact is that it is frequently very hard for both sides to reach an understanding. And the day-to-day reality is one of frequent disconnects in expectations. Processes taking months of listening and digesting each other's needs, and a relatively high share of them not going anywhere. All the elements anyone would expect in the early phases of a market in the making, which is what Spain is as far as corporate PPAs is concerned. However, through probably blood, sweat, and tears, we do expect these markets to gradually develop. Hopefully a standard will eventually emerge, and progress will accelerate as new entrants push the limits for healthier competition levels among off-takers. Renewable targets pressing, as Kim has highlighted. We doubt, however, there will be enough time to let this market follow its natural growth pace. We think that would simply be too slow. So this means that the next phase will require public tenders to provide offtake for a large number of projects to move forward in the short term. I think we all have seen the repeat announcement by the current government in that sense. And there's little doubt that equity will take Spain's regulatory risk again. So the only question to us is whether the upcoming auctions will eventually leave enough space for a parallel, strictly private, bilateral market to develop. Now, the demand side shows quite the opposite picture. Actually, every project wants a PPA. But that's only where every project begins. In fact, competition among many projects for few PPAs is so intense that not every sponsor is willing to close for the prices they go at. So, like with tenders, ever more sponsors are having second thoughts on whether it makes sense to close under those terms. Obviously, the shift is driven by the low returns they result in. So projects are seeking structures in which the upside for high spot prices can be shared, rather than left entirely to the off-taker, as a fixed price PPA would imply. Another common strategy is to reduce the contracted output, or to enter into supply patterns beyond a standard pay-as-produced commitment. Anyway, one way or another, sponsors are taking on more venture risk in order to meet their return targets. And these are only the first stages, of course. However, we see equity in projects in longer supply, way longer than off-takers. The pressure on yields, we expect to continue to push for more creative solution, probably also for larger risk transfer to sponsors and for much more sophistication. As it stands today, the bargaining power on the off-taker side is too large and the resulting pricing level is too low not to consider it a bubble. It is a real bubble, the off-take market. As discussed in the preceding page, tenders will be the short-term alternative in light of what we've seen in other jurisdictions, most recently in Portugal. However, whether they bring about the better pricing solutions is more but questionable. Now, this is my final slide. The debt market looks a lot more balanced. The sector clearly ranks high in every lender's list. Exposure of non-banks is also growing. News of investment grade ratings for contracted deals have become common. But the real news emerged a couple of weeks ago when a merchant project was rated investment grade for the first time, though not in Spain. Beyond contracted deals, and this is specific to Spain, also merchant projects are closing in the Iberian market. Admittedly, the market is not as steep at the merchant end, but the fact is that more lenders are considering or at least incorporating merchant elements into the structures. This means that, however, not only sponsors, also lenders find good projects are in short supply. What's obviously exacerbated for contracted projects, meaning there are more scarce than at merchant projects. The shortage of off-takers, however, powerfully attracts new, less solvent off-takers, mostly traders, whose creditworthiness sometimes makes, how should I say, risk officers at banks struggle with the kind of counterparty risk they're taking. Another point is curtailment is slowly becoming another relevant, very relevant point for credit people at banks. The concern here is driven by the anticipated grid congestion at midday hours, and is specific for PPA projects when they're generating at the peak. For now, wind and other renewable technologies are not considered to be potentially affected, but that is only a preliminary conclusion. What this clearly does is favors small PV projects up to 5 megawatt, which are not subject to curtailment, and also those whose power goes to local consumption rather than fed into the wider grid. Those will see the probability of suffering curtailment seriously reduced. As to the expected evolution, we do not expect debt players to incorporate merchant elements into the financing as fast as investors are demanding. The pressure on them is just not as high, I would say, as it is on the equity side. Well, and how does the demand for credit look like? Yeah, the headline is right. In this return-hungry context, leverage is an important driver. However, credit is not in every sponsor's list. All equity deals are a reality, but always on a fully contracted basis. Of course, they remain a small part of the market, as IRR levels are beyond most players reach anyway. Next in the leverage line are the merchant deals. Even though they arguably, I'd say, attract less debt than comparable contracted transactions, the difference in leverage can be surprisingly low. In fact, compared with project financings in infra or telecoms, even contracted deals cannot be considered highly leveraged. The off-taker's bargaining power tends to limit the project's revenue generation capacity, and around 75% leverage, 80% is normally off limits for most projects. The everyday fight is around sizing metrics, clearly, and they differ substantially between contracted and merchant revenue streams. And to the future, well, the foreseeable future brings more merchant risk for sponsors, It's probably going to be in the shape of hybrid projects in which contracted and merchant cash flows coexist in different degrees, with risk appetite and return requirements driving the respective proportions of each of these two streams. The debt market is, to the conclusions, is far from being a bubble, particularly for merchant projects, and lenders continue to dominate the scene, but solid projects attract significant attention. As always, the better structured the project is, the higher the chance to raise a competitive debt package. That's it from me. This is Voltiq's first review, fast review, I'd say, for the current situation and outlook of Spain's market for projects offtake and debt markets. This presentation, as Leoncio said at the beginning, is available for download from Solarplaza. And Voltiq, a specialized financial advisor, would be delighted to discuss possible cooperations with interested parties. Now over to Leoncio for the Q&A session. Thank you.
Thank you, Manuel. Thanks for a great presentation, very insightful as well. And we'd like to start the Q&A actually with a survey question to the audience related to the two presentations that we just saw. So basically, it asks you which of the markets, I think you'll see it on the screen now, which of the markets discussed today interests you the most? Is it the power market as described by Kim, the market for projects, the offtake market, the debt market as described by Manuel, or in the case that all of the above can also be true? So I'll give you around the 30 seconds, 40 seconds to answer. We'll review the answers in a minute. Manuel and Kim, what do you, well, I mean, this is a classic question, but what do you expect? Do you expect a preference for a certain market?
You want to take that one, Kim?
No, I think the thing to remember is everyone who approaches this opportunity, I mean, it is a real opportunity. We're not doubting that. The question is whether we're going to overdo it, right? So at the end of the day, it's interesting because I think there's at least the way I've observed it over the last 2 years, in particular the last 2 years, is it's part of a learning process. Right? Oh, there's this thing called a market. Oh, I thought I was just going to get a feed-in tariff. Oh, well, I don't like the market. I'll get a PPA. Oh, well, that will be a solution. And what Manuel has basically led us to understand is that the reality is a lot more complex, right? That's why I'm an economist, because I like to simplify things. So, yeah, so I appreciate that it's a little bit of everything, in my opinion. I mean, I'm actually quite, I tend to always look at the debt market, because I do think that we need to unlock project financing into this area. And if the banks are not happy, that makes me concerned, because I think it's much more difficult to find a solution, in particular when you're thinking about decarbonization target. That's all.
Okay. Well, actually, we already have the results from the audience. So the clear winner is all of the above, as you mentioned. The debt market got the lowest percent with the 4%. And just following all of the above, we have market for projects, and then power market and the offtake market. Well, interesting. I think this is a little bit of what we expected, but it's good to have the proof. Should we move on then to the Q&A from the public? We have quite some questions, and well, I will urge also the audience to still send in your questions, because we have 15 minutes for the Q&A. So let's see. Let's go to one of the first questions. I think this is something that Manuel was saying in the offtake market, about that a standard will eventually emerge. I actually just saw today on LinkedIn, quickly in the morning when I opened it up, that the European Federation of Energy Traders and a couple of other parties released a standard corporate PPA offtake agreement. So the question comes from one of our audience members, is about this, let's say, this corporate standard PPA agreement. Manuel, what do you think about this? Have you been able to see this standardization in the PPA in Spain?
Well, I didn't mean actually the contract so much in itself, but more, I was talking more about a risk profile. I mean, how risk is distributed between parties. and who takes what risk and to what extent, guarantee packages, all those kind of things, termination payments, in case of the PPA gets terminated halfway through, and make whole clauses, all these kind of things that are eventually part of the, say, earlier negotiation before you embark into the documentation phase. I mean, certainly this is not like the credit market where you have the LMA standard and or the EPC market where you have the FIDIC standards or any other that have been around for decades. This is, particularly in Spain, it's a new market. I mean, there is no tradition in this country of having contracted, industrial consumers contracting long term, and it's pretty new for everybody. So what I was talking about is more about that profile eventually emerging. Of course, there are different pricing structures. Of course, there are different ways to share the upside, and other points I've touched upon in the presentation. But what I meant really is that as it is today, there is not yet a standard, say, risk distribution that would be kind of repeated across transaction, across the board, I would say. That's what I meant, that standard will eventually emerge, because in other markets, that's what you would have in the UK, in the US, or in other more developed markets, where people more or less know what they're talking about when they start discussions about a PPA. This is not the case in Spain yet.
Okay, I see. And I mean, coming along to a little bit what you said, I mean, in the offtake market, for example, you said that you could share the upside between the parties, or limited the contract volume, or increase the merchant risk. Do you see any, let's say, any trend or any preference in the deals that you're working on?
Oh yes, indeed. I mean,
or one of the three.
Yeah, I mean, all three. In fact,
all three. Okay.
The thing started a couple of years ago, or I'd say 1.5 years ago, with the standard pay as produced fixed price long-term PPA, like that was the standard demand by sponsors, saying, okay, I want kind of the closest I can get to a feed-in tariff, but for a feasible off-taker. And then they started realizing that was basically leaving all the upsides for the off-taker. So now we see those evolutions as a natural step, I would say, trying to improve the IRR that standard would inevitably result in.
Okay. Can you quickly, like, just for those who don't know, how do you share the upside in these deals? Like, what are the terms? I mean,
well,
quickly,
for example, a contractor is to have a floor, and so if the pool price dips below that floor, then you get remunerated at that floor, and for the time it stays above that floor, you just get pool minus whatever the spot price is, minus 1, 2, 3 euros or whatever X, right? Obviously those two go in combination. So the lower the discount, different discounts to the spot price would result in different floors to make economics work for the other side. That would give the project the ability to receive income as to the spot prices minus that X, and also the safety net the floor represents.
Okay, understood. Perfect. Thanks, Manuel. Kim, there's a question from the audience directed towards you. It says that PNIEC says that in 2025, CCGT will be producing actually around 500 hours per year. How do you see the security of supply when massive renewables enter the market?
Yeah, the CCGTs, I said before that and that's still true. Even if we close down the coal-fired power stations, which I think there'll be like 2 gig left. We had 10 not that long ago. You close them all down, then you need that flexibility. You need that, and a lot of flexibilities will actually come from hydro. Except, as people like to point out, and we should be aware of this, the PNIEC doesn't make a big comment as to the intra-year differences in hydro production. But you should bear that in mind. I mean, if you have a pumped storage, you can handle issues around imbalances on the system much more readily than if we didn't have any hydro and we'd have to rely on batteries. So it's just why batteries are not being given a big hoo-ha or not being trumpeted in the PNIEC, right? The CCGTs are going to have to take on that role. But the thing is that if you're not in the day-ahead market, it's very difficult for you to be in the balancing market as well. Now, the good thing is that as the coal plant has been moved off the merit order and that's being closed, and is being closed down, there'll be more CCGT that can participate in the day-ahead market. Won't make any money, by the way, because we're still completely oversupplied. So I still think they'll be offering capacity at close to their marginal costs. But then what they'll be able to do is double dip. They'll be able to double dip into the parallel market for ancillary services, or as we're expecting to hear soon from ENTSO-E and the European Union is, you know, whether number one, whether we can have a capacity market in Iberia, and two, how would that actually be designed and developed. So we know what the general rules of that game would be. So that's another thing. So if the answer is there a problem with being able to absorb a lot of renewables? The simple answer is no. Right? There's two aspects to that. One's physical, one's market and regulation. Is Red Eléctrica prepared? Is OMIE prepared? The basic answer is yes. They know how that's going to do. It's been done everywhere else in Europe. I could scare you guys and say I think we're going to be moving away from the cap on prices between 0 and 180, and I think they will allow negative prices, for example. So things will get scary, but generally speaking, I think that we're okay. The CCGs are only part of the potential solution for that, but we certainly have to make sure that they also don't have a quote-unquote missing money problem. Otherwise, they'll all close, and then we'll be left with more significant problems.
Okay. Understood. And the following up to this, I mean, you mentioned in your presentation that you know, with the combined cycle, let's say bubble, the capacity factor dropped dramatically, right, after a few years. Do you see anything similar happening to PV, sorry, in the long run? I mean, this is a little bit related to the cannibalization webinar, but where, of course, we would have a lot of curtailment in the future. And adding up to this, there's also a couple of questions on energy storage. So how do you see energy storage playing a role? And how would it, for example, impact your forecasts?
Yeah, curtailment. Well, the links actually. So I made a bit of a comment about the storage with respect to the hydro flexibility, being able to dispatch less when prices are low, and then you dispatch more when prices are higher. So yeah, you have the pump storage, but you also have the normal dams. It's the run-of-river is the only one that can't really help on the storage side. With respect to curtailment, yes, that's actually a really interesting one, because I've noticed that there's a new paper from the government with respect to the implementation of the PNIEC as set out, and they're talking about effective operating hours, but then they actually curtail. There's a sort of curtailment adjustment. I've been talking to various people about that. Now, I'd be very worried if I had a PPA that was being paid, you know, on a pay-as-produced basis, and I was being curtailed because every megawatt hour that I don't produce, I don't get paid. Now, that's the blindingly obvious. The thing is, it's also blindingly obvious by what I call the parabola picture, right? The one that's part of the presentation and also was explained at more length last year. The thing is that you know that you will be, I mean, the chances of you being curtailed are very high in this equilibrium point. So we know that there's a lot of correlation between the production profiles of all the photovoltaic facilities. If the wind happens to be blowing or if demand happens to be a bit lower, whatever, you know, we will be basically seeing very, very low prices at the point in time when we're at our maximum points of production. Is that a bad thing, or does that affect your forecast? And the answer is no, because I'm only interested in your weighted average, you know, dispatch weighted average price. So I'm one of these guys that talks about making money on the, or at least the value of your asset to the system is on the sun up and on the sun down hours. If by definition, and we all know this, if there's a huge amount of oversupply of energy in the middle of the day, hey, look, the price is being close to zero. It's basically a way of telling you that we don't need you. Now, if you don't monetize it, that's okay, because you're monetizing it in other points in time. However, if you're fully committed under a project structure for financing purposes to be on a pay-as-produced basis, then you will have to be a lot more worried about the impact of this. But from a general system perspective, if you think about the study that the government has done for Red Eléctrica, for the PNIEC, I think they understand these type of concepts because they're just thinking about it in generic economic terms. Does the storage matter? Sure. I mean, I think it's interesting because the parabola pictures or charts show you that the chances of there being more the differentiation between periods of low pricing and high pricing will exist, and therefore that's what gives power to the battery storage argument. But my opinion is that batteries are still too expensive relative to operating your existing hydro. Except, don't get me talking about if we have very dry years in a row, right? And then we're going to have another type of problem. So, but that I'm going to leave that question aside. Yeah.
Okay. Thanks. Thanks, Kim. There's a question for Manuel regarding your presentation. Manuel, they say that regarding the 10% ratio mentioned for projects reaching COD. This is a question. This ratio takes into account projects that already have grid access or projects at the moment of grid access application. So just to rephrase that, is it for projects having already the grid access or at the application?
No. It was not meant in that sense. What I meant is that the hit ratio for equity players, for investors, is coming down, is substantially reduced. This is not about how many projects in the permitting line actually make it to the finish line. That's not what I meant. What I meant is that if you're an investor and you're seeking to buy projects, the hyper competition among different players is creating a situation where, you know, every project that's up for sale, particularly if it's a quality project, of which there are a few, attracts so much attention that your chance of eventually winning that competitive process is lower and lower over time. So what I meant by this is that on average, players get a 10% ratio. So of every 10 offers they send, only one is eventually successful.
Yeah,
that's what I meant. I mean, I wouldn't dare provide an estimate of how many projects of those that start eventually make it to the finish line as to permitting or development as such. I mean, it's that would be very difficult to estimate, one, and I don't think it would be representative because you need to look at different segments because there are big differences among technologies and types of projects.
Okay, understood. And well, there's, let's say, a question as well related, well, not exactly related, but what do you think about the survival time of the generation tax of 7%? It's not addressed to one or the other, so if anybody of you can take this question, what do you think about the survival time of the generation tax of 7%?
There are all sorts of opinions here. Frankly, it's difficult to tell. Like so many things with relate to the sector, with the current government. We just don't know when it will be implemented or whether not. I mean, look at what happened in Portugal. The expectation was that the generation tax would be removed by Spain, and Portugal was waiting for that to happen.
Yeah.
And because it was creating a distortion, it was sending the wrong signal in the market. And as you know, the Spanish market is 100% integrated with the Portuguese market. So it's this kind of distortion creates noise in the price formation mechanisms in the market. So the Portuguese were waiting, and they were told every time they called, they were told, yeah, we're going to remove it, but it never happened. And at the end, they lost the patience, and they created a similar tax just to compensate for that effect at the other side of the border. So that tells you that, you know, the willingness.
It's the big brother, right? It's the big brother syndrome. So what happens in Spain is what affects Portugal. Portugal basically follows Spain.
Correct.
If you ask me, and I think you'd appreciate the logic here, Manuel, is what we try to do from our side is we track the amount of sort of regulated costs and regulated income under the regulated regime, you know, and sort of look at what the net position is with respect to the tariff deficit and how they're repaying the debt and how much they have to pay out net on the existing feed-in tariff, the assets that are still covered by the specific regime, etc. So you know that bit by bit their liabilities and how much they have to pay off will be paid off. So at least if you're going to make an argument over how quickly the Spanish generation tax will be removed, be aware that it should be done in the context of what the overall financial situation is of the government vis-a-vis the tariff deficit and things like that. Do it that way. So you know we don't think it can be quickly taken away. I mean, for instance, you're basically last year at close to zero, all right, on balance, right? And that was, remember, they sort of took it off and they put it back on again for a few months. So you can start games like that. As the surplus increases, you're going to have some more flexibility of being able to take it away. But another thing to bear in mind, because I know people always ask about this, if you're being forced to be charged, as part of your income is going to be taken away as a tax, then obviously what you'll try to do is at least try and push up electricity prices to compensate. Obviously, you can't do that if you're under a feed-in tariff regime. It's just money that the government was taking out of your pocket. But be aware that there's a net impact from having the generation tax, which is slightly lower than which will be lower than the 7% if you are going into a merchant type deal, rather than if you're thinking of a tied, one of the assets that's still under the specific regime with a fixed feed-in tariff. There is a different financial impact on both those types of assets.
Mm-hmm. Right. Now, having said this, the fact of the matter is that everybody's running different scenarios as to what if it is removed next year, what if it is removed 2 years from now, what if it is gradually coming down, kind of phase out over time over the next 3-4 years. The multiple scenarios that are being run here because of the uncertainty around that.
All right. Well, thanks, guys. I think we're running a little bit out of time, so I don't want to extend this Q&A too much. But I see a couple of questions here that I can sort of, let's say, group together. So let's have the general question, which is: do you see any other market that we can learn from to avoid, the bubble in any of the markets? So projects offtake that power. And then there are two questions about the real estate market. So one is, how is the real estate market going to impact the solar market? Seeing that there's a lot of projects, pseudo projects, as the question says, being focused exclusively on commercializing land lease agreements. Okay, and the second part is that in Europe there is a trend to put for the government to force, let's say, housing corporations to install PV in their properties. Do you see this with the plan of the government till 2030? So yeah, it's a little bit of a convoluted question, but let's say about the real estate market, what will be the impact of this market in solar development? I think maybe
certainly seeing land lease prices going up. Obviously, the closer you are to the substation with available capacity, the better the price, certainly, and the more unique your position, if it's a large project, the better for you, obviously, as a landowner. Other than that, the other part of the question of where will people be forced in Spain to use the private surface on the rooftops to install solar modules? I don't think forced as an obligation is the right verb to use here. I think there will be incentives. There will be incentivized, so I would use the verb incentivize rather than force, if that is clarifying at all. And as to the first part of the question, is there a market we can learn from? Certainly, there is. Look at what happened in Chile, for example, with the collapse in power prices because of a few years ago, say 5 years ago, when just to use Kim's wording, when the sector got too close to the edge of the cliff and eventually fell down and provoked, the additional unit, the marginal unit that created that excess capacity, eventually made prices collapse. So certainly it happens, and there are plenty of examples, Chile being one of them, in the not too distant past.
Yeah, if I remember correctly about Chile, was a little bit also related to the price of I don't know which mineral, copper or one mineral that fell down, right? Because a lot of these plants were made for the mining industry.
Yeah, but that's the sort of question Kim, the sort of aspect Kim is an expert in analyzing demand patterns, different demand patterns. What happened in Chile is that, mining majors being the main drivers of demand, the fact that copper prices or other commodity prices were coming down eventually reduced demand. And if you have a scenario like that where demand is when demand is coming down and at the same time supply is going up seriously, of course it's a perfect recipe for a price collapse, which is exactly what happened. Whether that scenario is in Spain or not, that's probably better for Kim to comment on.
Well, all I'll say is I never helped finance any solar projects in the Atacama Desert in Chile because I could see that one. I could see that train rate coming from a long way.
Yep. Yep.
Okay, perfect. Well, I think we can close the Q&A now. So I'll just give both of you a chance to say some last words, some last thoughts on this webinar. I mean, I have to say there in this hour of webinar, there's a wealth of knowledge. So thank you both. Maybe Kim, if you want to start, and then Manuel.
Well, I mean, there's obviously, this is a multidimensional type problem, Rubik's Cube and all that. But join us in a month or so time. Join us at Solarplaza. Let's get together, have a conversation around the issues. Talk is cheap. Having conversations about what the other, it does illuminate you, does get you thinking about what the sort of issues are. Come and let's see if we can change your mind, give you a different perspective on things. And Leoncio, you guys do a really nice job. I like the roof terrace idea. Last year was down on the ground floor. I'm looking forward to it. Thanks very much.
Thank you, Kim.
Well, my last word is one of thank you to Leoncio again, and to you, Kim. Indeed, happy to discuss personally, both in the Amsterdam event that is coming up next week. We'll be there, as well as in the Madrid event organized by Solarplaza in Madrid in March. Perhaps we can have those face-to-face conversations and discuss real-life examples of current projects with anyone who's interested. Well, she'll be happy to assist in structuring your project and make it a success. Thank you.
Perfect. Really looking forward to March 19. So with this, I think I close the webinar. I'd like to thank, of course, our two speakers, but more importantly, the whole audience who was with us the whole time. Thank you. Just as a reminder, Solar Market Paris, Spain, 19th of March. Hope to see you there and wish you a great day. Thank you all.